Just to give you a quick intro, sitting to my left here is Vidak. I'm not going to say this right. Radonjic, thank you. Save me the embarrassment.
No.
He is the managing partner of Beryl Consulting Group. He helps people do due diligence on funds, particularly in the hedge fund area. Sitting to my right is Beth Glaccum. She is the managing director of Castle-Hill Partners. She'll correct my pronunciation of her name. And all the way over to the right is Blake Singer. I know his name. Blake's a terrific person. He and I have worked together on these panels before. So welcome, everybody. We're going to talk about a bunch of topics related to manager selection, including the current investment environment, investor appetites, perspectives of domestic and international investors, relationship between investors and managers, ESG and the fiduciary role, emerging managers, the role of placement agents and finders, due diligence, and I just listed a bunch of topics. If we get to three of them, I'll be happy. But primarily, it's how do you make money in this environment? How do you find managers that can help you make money in this environment? That's going to be the core of what we speak about. My name is Heil. I'll be moderating the session. I'm part of the institutional team for Pacific Premier Trust. We're in the self-directed IRA space. We help people make investments in alternatives using the retirement funds that has certain tax advantages, especially if you're in a Roth IRA. The institutional team works with RIAs, asset managers, broker dealers, family offices, and the like to try to bring on many accounts as opposed to just bringing on, retail where you're servicing one at a time. Just give you a couple quick things. We're working right now with an asset manager who wants to help his employees get into their deals in a co-investment fund. So we're allowing that through their retirement funds. I'm involved in that deal right now on a fund custody matter for a large private debt fund, about $3 billion in loans. We're also working with an RIA who's putting together a group of people to invest into a fund. They're putting up about $50 million for this fund. And about 10 to 15 of that will come through us. Those of you who've heard me before, I have one thing to do, being part of a trust company, being part of a bank. I got two sets of compliance officers. I must read a disclosure statement, so bear with me on this. Information is presented for educational purposes only and is not intended as, and may not be relied upon as tax, legal, investment, or other advice. Pacific Premier Trust performs the duties of a custodian and as such does not evaluate, recommend, or endorse any particular investment opportunities. You are advised to consult your professional advisors for specific guidance regarding your investments. Investments are not FDIC insured and are subject to risk, including the loss of principal. And I'll go one step further and say any opinion that I give here today is my opinion alone. It's not necessarily that of the banks or the trust companies. So now I've gotten all that legal stuff out of the way. I'm sure that Polsinelli could have written a much shorter, tighter one for us, but we'll have to get there at a future date. Let's get on and meet our panel. So just ask them to talk a minute about their background and then a minute about their firms. And Beth, I'm going to start with you.
Sure. Thank you. It's great to be here today. I have been working in the alternative business since 2000 and mostly raising money for hedge and private equity funds, but do get involved with some real estate and some direct deals. I'm working with Castle-Hill Capital Partners right now. We're a broker dealer right around the corner on 45th Street. We like to work with specialist managers, ones that have a niche. Some examples is of a diamond finance strategy right now, commodity funds, we have a Broadway fund on the platform, lots of venture capital.
So I'm sort of curious. Things have changed rapidly. We were in a pandemic 2 years ago. Despite that, things were relatively strong and continued on. But now we have high inflation, things of that nature. We've got a war in Ukraine. But what's the attitude of institutional investors right now?
Yeah, it's definitely, there's some concern. Is there going to be a recession? Is there not going to be a recession? What's happening with inflation? What's happening with the war? Our commodity products are seeing a lot of interest just because of what's going on in Ukraine. It's venture is still seeing some interest because there's protection there, such as a long-term investment. Real estate, everybody always likes real estate, family offices.
Sure. Well, it has that current income
Current
coming
income
back.
coming back. Anything with income is still a hot topic, but I feel like it's always been slow to close deals on hedge and private equity funds, but it has slowed down a little bit.
Very good. We're going to dive a lot deeper into that
Mhm.
conversation. Vidak, why don't you give us a little introduction to yourself and the Beryl Consulting Group and talk a little bit about what you do and
Sure. Thank you, Mark. Nice to meet you all here. So we started the Beryl Consulting Group in 2004 with a mission to find the best of the best hedge fund managers. As such, we have done due diligence on, I would say, over 500 managers in depth. We went through lots of cycles. So 2008, 2011, 2018, 2020, and now. So 5 ups and downs in the markets. It's been quite exciting world. We haven't never seen something like this. But on the other hand, we've been speaking to lots of managers. Some of them have been kind of riding this liquidity. And from that point of view, those managers we kind of avoided because we kind of knew what might happen with the, I would call it reckless Fed policy. We have done quite a lot of due diligence on quantitative managers. And in 2015, we started actually to get acquainted with alternative data managers who are providing, I would say, very precious data to quants. And the quants are then utilizing machine learning and artificial intelligence to kind of dissect and create some very complex mathematical algorithms. So we've been following these managers for a long time, and we have detected and identified some managers that can perform really well in the cycle when there is a chaos in the market like we have experienced in the last, I would say, 2 years. 2021, we had GameStop episodes, and now we have inflation, which is unprecedented in the last 4 decades. So we had to work much harder than before, and due to our, I would say, due diligence, we have identified some managers that have performed really well, and they're mostly quant managers in global macro buckets. One more thing that we do at the Beryl Consulting Group, we work closely with alternative data providers, as I mentioned before. We also now getting into digital assets. I think it's a good time to go into digital assets now that everything is kind of like flushed out, and there are going to be winners. There are going to be Amazons of the world, I believe. I think digital assets are here to stay. I mean, I was very skeptical about crisis. That was gambling, nothing else than gambling and hot air. But I think at some point we will see the market is getting into this, I would say, late stage when good managers, market neutral managers, are going to be able to provide really good returns compared to those guys who are just chasing returns in 2021, thanks to the loose Fed policy.
excellent. Thank you. And Blake, I'm going to flip it over to you. Introduce yourself. Talk a little bit about Amera Securities and what you do.
Yeah, Marty, thank you for putting this on. Peter, thanks for hosting us. I've got a disclaimer as well. If it goes up, it was my idea. If it goes down, it was yours. But I'm Blake Singer. I wear a couple of hats. One is with a small broker dealer called Amera Securities. We raise capital for emerging technology and some healthcare companies. And the head of the firm, who is based in Toronto, used to run Sprott's Hedge Fund, which is more of a mining type of fund. And so that is one side of the business. And then my partner and I also consult to family offices and registered investment advisors to help them build out their alternatives platforms. My background, I ran about a $400 million stat arb fund, ran a vol arb fund and a fund of fund back when they used to have fund of funds. And so take kind of a buy side perspective in evaluating managers. And kind of to answer your question that you asked, Mary Beth, we really look for managers that we look at managers as if we might look at a business. What's the strategy more so than what category they're in? Do they have a moat around their business? Do they have the infrastructure to support what they're doing? Does it make sense? So that's what we do.
Great. And you mentioned you do this for family offices, and you do this for foundations and other groups like that. Talk a little bit about what you're hearing from them right now with the current market conditions. What are they telling you? What are they saying to you? What's their reaction to what's going on?
Well, I think what's on everybody's mind is inflation. And, it's early on, there was a lot of discussion. Is it going to be, transient? Is it going to be for real? And I think what people are realizing is that it's gone far beyond supply chain issues or even issues with Ukraine. And it's not surprising given, the $3 trillion that trickled into the economy during the COVID relief package. And it's a lot of money. And it may seem like it's only $1,200 per family, but that's a lot of money. And so inflation is, and protecting against inflation is primary. Certainly people are feeling it on the equity side, just being long equities. And as Marty had said, valuations are coming down, have come down in the venture side. And we're seeing that more on the later stage growth equity side of venture rather than the early stage. The early stage venture has been somewhat, they've certainly had to deal with valuation, but not to the same degree that the late stage. So those are some areas that we've attempted to avoid.
And some of that I think has to do with the leverage that an early stage company or a seed stage company has in comparison to a later stage company, growth company, where they have momentum. They can show you they're grown 20% over the last 3 years. They're outperforming the market with what they're doing, et cetera, et cetera. And then, by the way, that justifies their $40-50 million valuation, as opposed to a seed capital firm that's starting up and has no sales, has an idea, maybe has a couple things in place, but needs money to really develop it.
Yeah, with the amount of money that's been thrown at venture capital, these large firms, Kleiner Perkins and all the really large firms, they have so much money to put to work that they just have been throwing it at growth equity. And there just isn't that much money sloshing around. There's a lot of money, but there's not that much money sloshing around in the seed A round type deals. And so it's tough to get them with the same level of valuation creep that the later stage companies.
And there seemed to me that, one of the big changes in venture was that in the early, back before 2008, they were all getting, particularly around 2000, they were all getting, $5-10 million worth of capital, and then, do with that, not as they please, but do with that according to their plan, start executing on it. It seemed that after that time, there was a lot of what I call spray and pray, right? Where they rather than give them that much money, $10 million, $5 million, they'd rather give, 10 different companies $1 million each and see which one performed, or which 2 or 3 out of that really performed well. So that seems to me the venture capitalists adjust their strategy. Any thoughts on what might happen
You know, it's interesting. There is a family office that we don't work with contractually, but they've created and it's actually open, a venture capital fund that is basically throw spaghetti on the wall. And they try to be with very small dollar amounts in a lot of emerging deals. And, you know, most of them don't work out, but, you know, like venture capital used to be, where a lot of the deals wouldn't work out and you get 110 bagger or maybe 120 bagger to make your whole fund profitable, and then some. They have a very interesting return stream. And there's another group in Brazil that some guys that came out of Goldman that are doing basically the same thing. They're placing money in very early seed deals because they know they can't get into the deals at their size in the B round or whatever. So they're spreading their risk out, and then they're adding money, keeping money on the side and adding it to deals that are emerging that show the technology's proven efficacy. And that to me makes a lot of sense.
Yeah, and Will's strategy of
And
venture,
Will's, yeah.
of venture lending makes a lot of sense. Do you collect warrants and things on your loans when you do them, Will?
We do, yeah. So safe with every deal, and then debt-like instrument with every deal.
Gotcha. So Mary Beth, one of the things we were discussing in our prep call was this whole idea of hedge strategies for inflationary hedge strategies. You want to talk about that a little bit and what you're hearing, what's sort of popular with the
Before we go on to
investors?
that, I'll just say I'm working with some venture funds too, and they're all early stage, and those valuations are holding up very, very good.
Yeah.
One investment just came in at like 10x.
Nice.
Alchemy was its sort of a blockchain infrastructure company. So
That's the one I could.
that is, yeah. But on the inflation side of things, I commodities is back. I mean, everybody was out of favor there for a long time. Historically, I worked for Osprey for years, and then I was at Lucas Capital, which was energy focused hedge and private equity. So now I'm working with two different commodity managers. One actually, they're both fundamental. I know you were mentioning systematic CTAs earlier, but I'm a believer in fundamental commodity strategies. I think that commodities are so volatile, and you really have to know what's going on in the marketplace to select it right.
Any particular area of commodities doing? I mean, you know, I thought it was always going to gold when the economy is going down or going
Right.
into a tough part, but it seemed to me gold was pretty well priced.
And gold could be argued that it's a currency. You know, there's always that debate there as well. And silver falls not far behind it, but you know, energy is still very important. We spoke a little bit about alternative energy that is growing. We're working with a solar manager. Solar, in terms of new power capacity, it's up. It's like 50% of the new capacity coming online, and then if you include wind and batteries, it's like 75%. So you're not getting it from natural gas or from oil.
Gotcha. Vidak, how do you find alpha in this environment if you're a hedge fund?
Well, as I said before, there are some hedge funds. They're called hedge funds, but they're not hedge funds. And there are some hedge funds that are, you know, taking care of the geopolitics and global macro and the Fed policies, and they're kind of reading it right. But also they've been also quite early in reading it right, and they got hurt in 2021. But these managers that kind of stick to the knitting are doing very well in the first quarter and second quarter of this year. Most notably global macro, and in terms of the global macro, the quant bucket, because these guys everything is run by machines, and machines are not emotional, and people are emotional. So lots of managers who got in love with technology companies, both in long and short, are kind of not in good shape these days. But those managers who were driven by machines, and the machines that have done quite a good job in looking at alternative data, they have done really well. You know, actually, judging by some indices, they are up like 15%, and the market is down. S&P is down what 18% or so, right? So they have done great job. They have generated positive alpha, and but most managers have not done that well. So that's why I think when you do the diligence, you have to look at global macro first, and then you have to look at the people, processes within the managers. The due diligence has to be done not only by just asking questions, but also shaking hands and knowing these people very well, what they do besides working, what their hobbies are, how honest they are, integrity. All these things takes lots of time. That's why when you do due diligence is an evolving process. It's something that you just don't stop. It's something that if you follow the manager, you should really know a lot about this manager. You should try to talk about other things other than markets, and to be able to see the integrity, the discipline in that individual.
So a family office comes here, they really wanted to do this deal with this fund manager. They hire you, they say, we want you to do due diligence on this. We want to do this deal. Now you go in, and you're finding some things that are not, maybe not on, I don't want to say not on the up and up. I don't want to go there, but I want to say things that cause you pause or concern. How do you have that conversation with the family office?
Yeah. So in our instance, what family does is just basically tell us, okay, can you bring 5-10 managers? We want to substitute our fund of hedge funds that we have, a liquid one, with let's say 3 to 4 managers. So we go out and then we look for managers that could fit that criteria. They don't really come to us and tell us, can you look at this manager and tell us
So
what
they
you
come
think.
at you and they said, we want you to find us.
Yes.
So you're really a finder.
We find the managers, and then we do due diligence, and then we discuss the process. And very rarely they would come and tell us, there's a manager in the city, can you go and visit? Sometimes that happens. In that instance, what we do is we look at the qualitative aspects, obviously, but we also look at the quantitative aspects as well, and look at kurtosis, skewness, and all this stuff that goes through the quant analysis. Because yes, the past performance is not indicative of future performance, but at least it's going to tell us something. And that something is we need to look at we need to dissect the returns, and we need to see how these returns are behaving in different business environment and different leverage, and what they have in their portfolios, etc. So it's really in-depth, I would say, analysis of their portfolios. They allow us to take a look, and most of the time they do, because they're very serious to invest money in them. So they open their books a little bit. They talk about their positions, and sometimes we detect some inconsistencies, and what we do, we just basically report that.
Beautiful. Okay. Now, it seems to me, particularly for these, AI type programs that are out there replacing Blake over here.
No, really.
For those AIs, how much do you get into the model and really examine the model and how it works and how it functions, and to be able to maybe identify shortcomings with the algorithm or whatever, and how it picks and chooses and things of that nature? Just how much into the weeds do you get?
I would say from 1 to 10, we can get maybe 6 or 7, and then there's a kind of like a wall,
Yeah,
black box, where we have to, see the integrity of the managers and the operations, the infrastructure, and we need to trust them. So I would say 30% is qualitative, but before that, we are able to kind of talk to them, and they are very kind and transparent in terms of telling us how they do things up to the certain point. And after that, that's pretty much, we need to look at them in the eye and kind of like more, I would say, judge them qualitatively.
Quick question. Do you, on your quantitative managers, when you're looking at the models, are you trying to also identify what in the real world that model is trying to arbitrage or pick up, right? There's got to be something in the world that is causing that inefficiency. Do you guys kind of look backward at that as well on a qualitative
Yeah, I mean, we obviously it's quite, I would say, easy to go back. But in terms of the future, we do need to know, we have a good, I would say, we try to assess where is the Fed going? And that has been a big issue because nobody knew where the Fed was going. So 2021 was quite a difficult year. But this year, because of we're getting into, I would say, in a sell-off mode, where all those managers that were blindly putting money to work they're not working very well, like Tigers.
Yeah.
Tiger lost $15 billion or 20 or so, and then there's another Target Cup as well. So those guys were basically doing well because of liquidity, right? And those managers who are much more cautious and they were market neutral and low net, they were not doing so well because nothing really made sense. Everything was just going up and up. So whatever they're shorting, they were losing money as well. But this year, those managers who were sticking to their knitting are doing very well. And those managers were the managers that we focus mostly because there's those managers who are creating alpha. And that's why people get paid for that.
We got Marty here.
Guys, you guys have been around for a long time. A group like Tiger loses 50% this year or more, right, because of leverage. Do they come back from that? I mean, based on your hedge fund and you've got, to meet these goals where you can start paying, collecting fees again? Any thoughts on that?
It's really depending how good their investor relations staff is and how
It's an
well.
IR issue.
Yeah, I think so. And how they're communicating and where the losses came from and why, and is it recoverable? Do they believe it's recoverable? I've seen funds in that situation offer deals to existing investors, like we'll give you the old high watermark to come in and re-up and so we can make back money. So it really depends on how they handle their communications.
Right. It's a challenge though, keeping talent. Because a lot of their talent, is dependent upon making that performance fee.
Exactly, right.
And if you're a hot commodity and you're in a fund, even though your section may have done just fine, like in a multi-strategy fund, you got to live with the firm's clawback. And so keeping talent is difficult in those situations.
Yeah, I mean, it's like
Especially in
stepping,
this market.
it's like stepping through a door, right? We're going from a zero interest rate policy to a brand new policy with the higher interest rates. So if the strategies that worked in zero may not work in you.
Yeah. Well, Melvin tried to start a new fund, and then it didn't work out. So now they're closing completely. They try to avoid this high watermark.
Right, and then others will diversify into other strategies.
The other one, Tiger Global, I think they've fully diversified. They have pre-seeds and VC stuff, so they're not just in hedge funds. The hedge fund portion is the one that got decimated.
You can do what Niederhopper does, just start a new firm each cycle.
We'll do crypto, right?
Yes.
Yeah.
Well, Blake, I actually wanted
That's a
to
good
come
one.
over to you.
Right.
Being an outsourced CIO for family offices, RIAs and, foundations, it must be a lot of pressure to get them into funds they can't access themselves. So talk to us a little bit about your strategies, about how you help family offices and RAs do that.
So there has been a big democratization of alternative investing. And it came through the Jobs Act under Obama, and that allowed for crowdfunding and all of these things. And it's been fantastic. And as a result of that, there have been some fintech aggregators, so iCapital, Case, they've done a great job getting access to Millennium, which is a great, fund that had been very difficult to get into, and a number of others. And I'm talking more about the big box names. And so there is, and at the same time, these large asset managers are realizing that in aggregate, the ultra high net worth or even the high net worth investor in aggregate there's a lot of money there. And if they can deal with one access point rather than 500 different clients, that's an opportunity for them. So we don't use we have used some of the aggregators a little bit. what we've tried to do is identify managers that I wouldn't call them emerging, but managers that are very seasoned that may be doing something different and starting a new fund. And, we have access to that. An example is there's a group that came, the gentleman was one of the founding partners of HarborVest, and phenomenal track record. He's probably in his mid-50s, and he also served in the military and has worked with defense contractors. So they put together a venture capital fund that kind of brings together Silicon Valley technology and defense, not missiles, but more AI and cyber security, things like that. And they'll probably be the preeminent fund of that sort. But they're starting out. They've got incredibly seasoned people. They have Ash Carter and McMaster on the board. I mean, it looks like a defense contracting firm. So that's something, identifying a firm like that that's going to be large, that is going to have access problems down the road. Trying to get to them early is critical.
Sure. So you got some money in there for your investors. They must be quite pleased.
Well, there's they haven't monetized anything yet, but
Gotcha.
it's a good place to be.
Gotcha. Mary Beth, I wanted to come back to you a little bit. And, there's a lot of, I don't know about you, but I've never met a second tier fund manager at all. They were all top tier. Oh, every single one you meet. But anyway, a lot of managers out there have a great track record and a good team, really smart people. And they don't wind up getting funded, for whatever reason. What are some of the key characteristics that take you from, that sort of perch to getting funded?
Yeah, every day I have a fund reaching out they're looking for that anchor or seed capital, and that is almost impossible to find. They have to find it within their own network. It has to be from the platform they just came from, seeding them, or from their own friends and family. It's just really, really challenging if they're unknown to go out to new people and get it in. So you need a little bit of luck there. But once you get, it doesn't have to be a lot of money, 5-10 million, then we can start bringing it to other investors. And that, each 10 million more, 25 million more, it attracts a different investor type. So you start small with family offices and just go from there.
It's so, I see a lot of hedge funds out there. They're $10 million and 3 years later are $11 million.
Right.
So,
It's a lot of work. There's a lot of touch points in terms of getting capital. The sales cycle for a hedge fund is 18-24 months. It goes back to communication, making sure you're sharing enough information. You're talking about top tier. I had a fund approach me recently that had really, really fabulous returns, but we couldn't make sense of them. They said they were in GameStop, but they were only in it a short time. And like, how did you get there? And so I ultimately didn't bring that to investors because we couldn't make sense. It's not to say that there was any fraud, or I don't want to suggest that, but we just really didn't feel comfortable with their story.
take you back to, I represented a venture capital fund a while back and helped them raise some capital. And the managing partner there told the story of he came across this great vodka company. Now they're in enterprise software. That's their niche. So he took it to his investor, said, I know this is not what we do traditionally, but I really love this company. I think it's going to make a ton of money. His investors looked at him. You can make the investment, but you better be right. And I think that's sort of the lesson there, right?
And what Vidak was saying either, like you want managers that are going to stick to their knitting too.
Yeah.
You don't want them to be going offline like that.
Exactly. Vidak, there are a lot of great analysts out there who write great research papers, super intelligent folks, but when it's their turn to sit in the seat and make the calls on what to invest in, don't seem to perform well.
Yeah, I can say a little bit more about that. So, for example, lots of people are blaming the Fed So to what happened, including to myself sometimes. But then you have people from JP Morgan, Bank of America, all these big banks, great degrees and everything else. And they're just pumping and pumping and pumping and going with the Fed and telling everybody, the whole world, don't fight the Fed, don't fight the Fed. And that's all they're telling you. And everybody is saying to the moon. Not only crypto guys, but the whole market has been just going up and up. Everything has been going up and up. And these guys are supposed to be excellent analysts, writers, according to their pedigrees and degrees, etc. But at the end of the day, they got it all wrong. So why saying all the time, don't fight the Fed, don't fight the Fed, etc. So it's wrong. If the Fed is wrong, admit that and tell your clients you're working for them, right? And so I would say lots of people failed simply in 2021, especially. The Fed has been late to acknowledge there's going to be inflation. It was just, to me, it was 101 economics. And then you had all these other sell-side strategists and analysts basically just telling the whole world, the whole global financial world, don't fight the Fed. And here we are, we're down 30%. And according to PE ratios, we're still overvalued compared to 2000. So we are not that, we're not being destroyed at all. We're still highly valued. So to your question, Mark, yeah, they are very smart. They write really well, but at the end of the day, that doesn't mean anything to me or to people that we work with and the people that we want to protect the capital for.
Great, Marty.
But, so Vidak, I understand where you're coming from. As I said, we ran events for 5 years, with like top CIOs all saying that they was gonna raise rates in 6 months and never happened, right? So we stopped running those panels.
Yeah.
So my question is, there's a lot of leverage in lots of spaces. And I think we're just at the beginning of the deleveraging process. I mean, so what's your timing on this? I mean, you talked about digital assets, but to me, digital assets are incredibly over leveraged right now, right? People borrowed money to buy them. And now we're just going through this deleveraging price, and if, I think if Bitcoin goes under, $15,000, a lot of corporations who bought Bitcoin are going to have to, they've got margin calls at that point. So, I mean, what are your thoughts about the deleveraging process? Because the strategy may be a good one long term, but probably isn't good the next year. Any thoughts?
Yeah, I think there are some amazing institutions like the Bank of New York Mellon. I think they have those data, and we've been kind of looking at those data, and we're still kind of, you're absolutely right, Marty. There is deleveraging process in place, and there is more to go. However, I would say, from 1 to 10, we are maybe 6 or 7 where in terms of deleveraging. So there's still more to go. And now it's all about the data, right? So if inflation is, or somehow we get in stagflation, that means inflation is going to go down, right? And that might actually, create maybe some other issues. There's going to be unemployment. Lots of big banks are now laying off. In terms of crypto, digital assets, people, big layoffs there. I mean, Coinbase laid off 20%, and they are like benchmark for everybody, right? So I would say it's going to be very extremely volatile 2022. We just don't know if we even have some kind of like a nuke word in use, because don't underestimate Russians and how they think. So, in my opinion, they get a little bit too reckless and too, I would say, emotional towards what British are trying to do. All the bets are off. So I would say there's a lot of fat tails ahead of us, and I think preservation of capital is the key in this environment. And you got to be really good trader and very disciplined in order to navigate this, and don't get relaxed. If we have this market rallying now, from Nasdaq has rallied 1,000 points, right? So people think, oh, we're going to get into V shape like we did in year 2000, but that's not the case, because inflation is 8%. The Fed is now doing opposite what they were doing before, so we're not going to get V shape. It's illusion, I would say.
Yeah.
So I want to flip this question. Actually, beautiful. Why don't you chime in?
So curious sense, it always used to be said that during inflationary times, equities are not a bad place to be.
That's true. That's
You
true.
know, and
But
here
no.
we are, it's only in hyperinflation that you really start to get a crash of everything. So why are we having this equity effect in the beginning of essentially a moderate inflation compared to world standards? I mean, I'm originally from Southern Africa, from Zimbabwe, okay? So I know very well what can happen with hyperinflation. I have a $2 note, which at the time of the establishment of the Zimbabwe dollar was par, okay, $2 to $2. I went back and I bought a $5 billion note in 2014 with $2. And so that's hyper. The question is, why do you think that the equity market has suffered so badly in a situation where prices can be costs go up, but prices go up too, and so margins can be sustained. It used to be a shelter to be in equities and not in cash. Now people say go to cash.
Can I take a stab at that?
Yeah.
It's been, I don't know, my observation or experience that oftentimes it's not the base level of, say, inflation or interest rates, it's the rate of change that scares the heck out of markets. So I think that in looking back in history, once markets, be it inflation or interest rates or whatever that might be, commodity prices, obviously inflation, if they level out, the markets can get used to that. They can get pricing, they can figure out what they can pass on to their customers, they can figure out what they can squeeze on the other end, they can work out the financing. It's the change, it's the dynamic nature that just from corporate America, they can't plan for it. And from investors, they don't know how far it's going to go. And I think that could be a portion of the decline that we've seen rapidly as rates have gone up and as inflation's gone up. I think that's the rate of change is far more impactful than the base level, whatever that, with the exception of hyperinflation.
Last month, or just a few weeks ago, I guess, out at San Francisco, I ran an economic outlook panel with a couple of CIOs from RIAs, and one of the two gentlemen who was part of that panel discussion, the other one agreed with him, was he was saying this is the bubble of all bubbles. This is because everything has been inflated. All the prices everywhere have been inflated due to the leverage that's been put into the market. And now we're deleveraging the market, all those prices are going to come down. So it's part of the reason why equities are being included in this. It'd be interesting to see if they fall more or less than the rest of the market on the after part of this. But it was part of his explanation for why it was happening.
He used the guy who explained it was the former chair of the Stanford endowment.
Yes.
I think it'll be interesting too if things like consumer staples stay stable.
Commodities. You said that already.
I know, but I'm just thinking in equity markets,
Yeah.
companies that sell food that are.
Well, and that's interesting because food prices have obviously shot up. There's some big discussion from the Biden administration about food shortages coming. Some people say it's going to make the 1930s look like it was nothing. Flip them on the map, which is pretty scary to me. So when you look at that and you're hearing these things, what's going through your mind in terms of the investment world with commodities and particularly the food agricultural businesses?
And that the public real estate equities have been crushed as well. You can get a lot of interesting exposure there versus how expensive you're paying on the private side.
We got about 10 minutes, right?
Okay. We got plenty of questions to go and plenty more discussion. So
My question is, what's more important today, niche, capacity, or safety?
I'm not sure they're mutually exclusive.
Maybe not, but I mean, I could find a great niche secondaries fund and maybe I can survive on it for the next year. Or you could say, well, I want something that's got lots of one room, right? I mean, secondaries historically are not going to be large capacity, right?
Right.
At some point, the spread narrows from 40% back down to historical 5 to 10%. So what's important today if you're looking at managers?
Yeah, I would say that's more opportunistic and yeah, I completely agree with you. We talked about it. Distressed is going to be, and I don't think we're there yet, although that big hedge fund that just liquidated a crypto fund, $600 million.
Which one was that?
I forget the name of it.
Singapore. In
Yeah.
Singapore, yeah.
Yeah. They lent $600 million to a levered crypto fund. It was a hedge fund, and it was two tranches, two $300 million tranches.
Mhm.
It's real money.
Is
And
that Celsius we
What
talk
they call
about?
crypto funds.
No, there's a
yeah,
fund in
and
Singapore.
Oh, it's like.
Yeah.
just at a quick aside, I was at the conference in March in Austin, and it was during the South by Southwest, and there hadn't been a chink in the armor in terms of crypto. And I mean, everybody that was doing crypto was cool. They looked cool. They had the swagger, and it's amazing how quickly things change. So anyway, Marty, I think opportunistically distressed is a great area
If you can find it, yeah.
if you can find it.
Yeah, I would say it's stock picking also. So market neutral managers should do well as well, because there's dispersion returns, and we're going back to the basics of what fundamentals matter.
A lot of great companies are born in times of recessions. And Blake, you speak about having a moat around the business or around the strategy. Can you talk a little bit about the moat, how you diligence that to make sure that it's sustainable and lasting?
Yeah, so for on the large end, right, a BlackRock or a Blackstone, right, their moat is that they've got so much depth and they see so much. The problem is they have so much money to put to work, is kind of the flip side of that. A quant firm like Millennium, right, they've got an incredible moat around their business because they have over the years built and spent billions of dollars on infrastructure, hiring people, and their internal infrastructure is amazing, apart from their ability to hire managers. And so that is a significant moat around their business. We couldn't collectively start a Millennium and compete with them. For smaller managers, we've got a manager that they buy property tax liens. So they manage about $30 million. A property tax lien could be a $3,000, $6,000 lien on a $300,000 property. Tax lien comes before the bank and it comes before the IRS. So I can't think of anything more secure. It's just they have figured out a technological way to manage $30 million in $6,000 and $3,000 tax liens. That's a heck of a moat. And they've generated 9% returns with a standard deviation of, 0.2%. I mean, but you can't put a lot of money to work there. So, but that's a moat.
Mary Beth, I'm going to put it out to you. You have managers that you evaluate, you look at, and obviously you want to be sellable and for people, for investors to like them and want to invest in them. So they sort of need moats around them as well.
I want to invest myself in the managers I'm working with. So like I use that as a criteria, like would I invest in this product? I work with smaller raises, like mostly, 100, 150 million. So the infrastructure does not look like Millennium. And you have to it's a different navigation to figure out what's going on. The honesty and integrity is very important at that size. Like I even check, to make sure, our employees, real employees. A lot of times they're, somebody's just on the website and they're not paid, and what's the likelihood of them staying there, and how is the work distributed among a team, and what technology they have in place. So I want to. You also want to see that there's a real ability to grow. Those managers we were talking about earlier that just never seem to put any effort into marketing, and 3 years later only $1 million more are not of interest.
I don't know why.
Yeah.
And I think people that perceive you as a hired gun is also another negative.
Well, yes, and I was thinking about this earlier. I always worked in house for funds, and I was, I had a salary, and I knew the products to a different level than I do now as an outsourced salesperson. But I'm licensed. I wasn't licensed when I was in-house. I'm reporting to FINRA. I have to tell them everything I'm doing. Like, I think there's real benefits to being outside. From you as an investor, like who's approaching versus somebody in-house versus outside.
I was curious, and this kind of touches on this great discussion, by the way. It's touching on a few things. Is for emerging managers, do you think it's better to be, we talk about this a lot, is it an absolute niche, or is it a generalist within a niche that is interesting where there's opportunity to be had at a certain given time? I'm curious to your thoughts on that.
I'm always biased to the niche manager. Like, it's just something, I like the story that can be told. I like that there's a special skill set, but that's not what everybody, there's a world out need for broader managers.
Yeah,
It's a more concise story too, right? You've got a real domain advantage.
niche is good, but the thing is, there are so many different business cycles, and sometimes those niches don't work in different business
Good
cycles.
point.
So I
Yeah,
think it's better
commodities
to
is
be a
a
little
perfect
bit more diversified and then have niche and then be able to be nimble and to adjust that as well.
Sort of on that thought, Vidak, how do you weight, say value contrarians, opportunistic and momentum selections? You mentioned GameStop a little bit earlier. So when you're in sourcing managers and looking at various asset classes,
I think we go with the managers who are nimble, who can adjust to different business cycles. That's, I think, very important. We don't want to get stuck with somebody who is just performing well in a certain business cycle, because business cycles are changing. They're changing because of different reasons and unexpected reasons. So we need to find the managers who can do very well in various business cycles. That's actually one of the things that is on top of our list.
so the ability to pivot and shift and, still figure out a way to make money, even though,
Yeah.
last
It's
year it
very
was a
difficult.
pandemic and this year it's high inflation.
Yeah, and then you have to look at, okay, so fundamentals do not make sense, but there's a flow going in. So, okay, it's so hard to understand that, but we have to find those guys who really are amazing in figuring it out. And that's why they get money, they get alpha, they're amazing. And those guys are not too many.
So Blake, I'm gonna put it out to you because I think you deal a lot with this question as well. How do you look at this?
In terms of segregating,
In terms of choosing managers, and you've got, how do you weight, say, a value contrarian, an opportunistic momentum play? And how do you work that out
So-
in your mind?
we look at it maybe a little bit differently, is that we look at businesses. And if that business, that moat, that niche happens to be in a quant strategy and they're getting 10 terabytes of data and nobody else gets that kind of data and they know what to do with it, right? That's a business and we can understand it. That's a business and we'll look at that. These guys that do the tax liens, this defense contracting hedge fund, venture capital fund. I mean, apart from managing money in venture capital in their area, they have a real business around what they do. And so we kind of look at things differently in that they don't fit in categories, even though I like distress. I want to find somebody that's got a business in distress, right? Really, I think that as these fintech aggregators that have a lot of retail clients in them, if things get really, really bad, there's going to be a business in buying retail shares, secondaries of these fintech, from these fintech aggregators. That's a business. Doesn't exist now, but somebody who comes up with that, if that opportunity presents itself, that's a manager, it's a business, it's an opportunity. So that's how we look at it.
There was a PitchBook article that talked about how they had a listing of more than 20 companies that went public in the last 2 years that are worth less than the venture capital they raised.
Yeah, and there's some good business. I would think there's good companies there.
You have to think that's something very different than being worth less than your IPO price.
Yeah,
Right? You're worth actually much less than your IPO price. You're actually worth less than the venture capital raise.
shows you the valuations in VC in those vintages.
So I know a lot of people talk about, capacity and niche, et cetera, but so all your different strategies have different paths to raising capital, right? Can you talk about that a little bit? Because obviously, Chip Perkins is a great guy. He's spoken at our event several times. He won't touch a fund that can't raise more than $1 billion, right? Any thought, I mean, there's a different path for each sort of strategy. VC has a very difficult time having capital raised by third-party marketers historically.
Yeah, VC has been challenging because of valuations and everybody's overweight at the moment. So people feel they're at the capacity there. So, and they're still doing very well, but it also, I think the timing of it is interesting. I think this is going to be a good vintage year for them. So I think there should be money going there. I mean, there's a lot of new technologies that people are using to raise capital, from doing podcasts to, doing videos that you can share in an email. It's very, very difficult to get investors on the phone. It used to be much easier. And sometimes I joke that the manager should pay me by voicemail or email. And
Pay per click.
yes, but it's still a relationship game.
I was going to sort of drill down that area a little bit because when you're looking at a fund, and you've mentioned this a couple times, it's communications, but it's not just communications, it's also the back office and it's policies they need to have today, their ability to deal with changing regulations. And we don't have a regulatory attorney up here, so you're all spared that whole conversation. But nonetheless, particularly sophisticated investors want to see funds have the ability to handle all that.
Right.
And so, the operational due diligence became very important. And then pandemic hit. And so what's sort of the flavor of the day today? Where is this going? What's being looked at? How are they doing these things?
I just went through a Mercer ODD with one of my funds, and they spent a lot of time on the technology. This particular fund used the OS 33, which FINRA and SEC have said is an appropriate secure system. But really on also the automation of subscription documents and signing things, making sure everything's secure, wire instructions, that was a big focus.
And, as a result of going through that, and then looking at all those different things, does that give a sense of comfort to investors? And that's probably a foolish question, probably not the best.
And I work with
smaller.
Yeah, so some of the smaller funds don't always have all the infrastructure that Millennium will have, but you want to be able to see that you'll go forward down the line and put some, as you grow, put better infrastructure in place.
Great.